Hi there, in this video, we'll explain how the Residence Nil Rate Band works and how UK families can legally reduce inheritance tax liabilities.
A single outdated clause in a will or a slight miscalculation in your estate's value can cost your family hundreds of thousands of pounds in unnecessary tax. Hello, I'm a UK tax expert from My Tax Accountant, and today we are breaking down exactly how to protect your home using the Residence Nil Rate Band. This diagram shows your baseline allowance. Every individual in the UK has a standard nil rate band for inheritance tax, allowing you to pass on £325,000 tax-free. As confirmed in recent budgets, this figure is frozen until April 2031. If you own a home, the government provides an additional housing allowance called the Residence Nil Rate Band, which gives you another £175,000. Stacked together, that is £500,000 of tax protection per person. For a married couple or civil partners, these allowances combine to shield up to £1 million from inheritance tax. Getting that full million requires navigating strict rules. The most rigid is the direct descendants requirement. To claim this extra housing allowance, you must leave the property to a child, grandchild, adopted, or foster child. If you leave the house to a sibling, a niece, a friend, or a charity, you lose the allowance completely. Simply owning property does not guarantee you this tax break. If your will ignores these rigid beneficiary categories, £175,000 of protection evaporates the moment you pass away. This timeline illustrates how the allowance transfers if you are widowed. A surviving spouse can inherit any unused allowance from a previously deceased partner. You can claim a 100% uplift even if your partner passed away decades before this allowance was introduced in 2017. This transfer does not happen automatically. When it comes time to administer the estate, your executors must actively claim the uplift by submitting a specific document to HMRC, known as Form IHT 436. This scale shows the most dangerous trap, the £2 million taper threshold. If your total estate exceeds £2 million, the government begins withdrawing your housing allowance at a rate of £1 for every £2 over the limit. Business owners and farmers are often caught off guard here. HMRC tests this threshold against your gross estate. That means assets qualifying for business or agricultural property relief are counted in that initial £2 million test, severely inflating your valuation before those reliefs even apply. Let's test how this taper works in practice. Pause the video for a moment and try to calculate the lost allowance for a single person whose estate is valued at £2.1 million. Here is the math. The estate is £100,000 over the threshold. We divide that excess by 2, which equals a £50,000 penalty. Subtract that from the maximum allowance, and the available housing band shrinks to £125,000. Because this cliff edge is so steep, keeping your gross estate below £2 million is crucial. Proactive lifetime gifting, such as using the 7-year rule or normal expenditure out of income exemptions, is the most effective way to keep your estate under the limit and protect your allowances. This schematic illustrates another common error hidden in the fine print of older wills. If you leave your qualifying property into a discretionary trust, the law views this as a break in the chain. Because the beneficiaries don't have an absolute right to the asset, the property is not considered closely inherited, instantly voiding the housing allowance. There is a strict temporary escape hatch. Under Section 144 of the Inheritance Tax Act, trustees have a 2-year window after death to unwind the discretionary trust and appoint the property directly to the descendants, which retrospectively rescues the allowance. What if you no longer own that large family home? The rules account for this through the downsizing addition, ensuring you aren't penalized for moving into a smaller property or into residential care. To qualify for the downsizing addition, you must meet 2 conditions. The original property must have been sold or given away on or after the 8th of July 2015, and you must still leave other assets of an equivalent value to your direct descendants when you pass away. Past lifestyle decisions, like downsizing, and outdated legal drafting, like old trusts, dictate your tax liabilities today. This makes an immediate review of your estate plan absolutely essential. This checklist summarizes the 4 pillars to maximize your tax protection. Verify your property passes to direct descendants. Ensure your executors know to claim any deceased spouse's allowances. Actively monitor the £2 million taper threshold. And review your will to make sure discretionary trusts aren't destroying your exemptions. Please remember, this video is for educational purposes only. Tax rules and thresholds are subject to change, and you must consult with a qualified professional before making any financial or legal decisions. My tax accountant is here to help you navigate these complex thresholds and structure your estate so your family wealth is protected from unnecessary taxation. Inheritance tax is complicated, but taking proactive professional action removes the risk. Call us today on 020-8570-8531, email info@mytaxaccountant.co.uk, or visit our website to secure your family's future. And please remember to like and subscribe for more tax insights.